Well, welcome back to another episode of the Property Trio, where we bring you the latest insights and advice on property investment, home buying, mortgage strategy, and money management. I'm Dave, and as always, I'm joined by my fantastic co-hosts, Kate and Mike. How are you both today?
Great, Dave. I'm excited for today's topic. What about you, Mike?
Doing well, yes. Well, I've been keeping my powder dry on the tax depreciation super nerd stuff, but I've weaved a little bit into it today because it's tax time. It's here, right? And for me and for a lot of people, it's exciting. For the rest of the people, it's, oh gosh, we have to do that again.
So, as Mike's just alluded to, today we're tackling a very important topic for all property investors out there. It's what property investors need to know at tax time. And Mike, you've done some deep digging into what the Australian Taxation Office is focusing on this year. Can you give us a brief overview?
It's funny, isn't it? Like the ATO say, this year we're targeting, the cash economy and tradies, or this year we're targeting multinational corporations avoiding their tax. I'm like, well, shouldn't you be targeting all of it concurrently? Like, does that mean like we've got this focus so people can sneak around the back door and do the stuff that we're not looking at? I think it's all kind of just a bit of rhetoric, really. But one thing that they have been saying over the past couple of years is they've cited this 90% failure rate on property investor tax returns, i.e. 9 out of 10 tax returns filed by property investors have errors in them. And there's been a lot of talk about, is that a purposeful, tax fraud from investors, or, given that most investors use registered tax agents, the accountant bodies are sort of saying, well, like it's not our fault, like we're doing everything right. But the nuts and bolts of it is that there are really been 2 or 3 things that they've focused on the last couple of years. One relates to loans and the deductibility of the interest components of loans. Now, people get into some sticky situations where they're redrawing equity and they're using it for non-investment purposes. And I'm going to leave that topic
very
to
common.
you, Dave, because that's a big one. The other really big one is the difference between repairs and maintenance and depreciating assets. And that's something that I think a lot of people don't understand. And it's really important that people get that right, because the ATO have very clearly said that you are in breach of tax legislation if you aren't allocating them properly.
Yeah, look, it doesn't surprise me to hear 90% of people claiming deductions on investment properties are making errors, because I would say it's about that ratio that we see with anyone who owns investment properties and their mortgage structure. I would say 9 out of 10 have errors in the way their loans are set up that would cause them to be making mistakes in terms of how they claim tax deductions, which we'll get into some detail on later on. So, look, that's really interesting, Mike, and thanks for doing that deep dive into the sexy topic of tax. So let's break this down a bit further. Kate, can you explain what non-deductible interest payments are and why they're a focus for the ATO?
Yeah, sure can. Non-deductible interest payments typically arise when investors incorrectly claim interest on loans that they're not strictly for the investment property. So, for instance, if you've used a portion of the loan for personal expenses, that interest isn't deductible. The ATO is targeting this to ensure that only the interest directly related to the investment property is claimed. And we've spoken about this before, the purpose test. I think a lot of people misunderstand that or misuse it, whether it's deliberate or accidental.
Yeah, and I think there's a mix of both, to be honest. Yeah, cool. That's really useful explanation for our listeners. Thanks, Kate. So Mike, what should investors do to ensure they're not caught out by this? What are some of the things they can, tips and tricks we can give them?
Well, the most important thing is to just keep the meticulous records, right? Because it's so often the case that people will redraw equity from an investment for a car or for, to pay down perhaps some debt on their principal place of residence, or a holiday, or crypto, or whatever people are up to these days, right? And so if you're claiming deductions on those interest payments, that's a non-depreciable, that's a non-deductible claim. So
Mm.
unless you have the specific information and you can kind of sequester it into these little boxes, you are going to make those mistakes. And as you say, sometimes maybe it's strategic. I'd hate to think that investors are being naughty and trying to defraud the federal government, but I do think that a lot of the time it's just an accidental thing, because it's a bit of a quagmire, especially if you have a reasonable portfolio with a lot of different things in play.
Yeah, I often say, I've said on the podcast before, I would say 100% of the time when people come to us owning multiple properties, they have problems with their mortgage structure. Now, that isn't always that they'd be claiming incorrect deductions. Often it's they're missing out on claiming deductions as well. But we certainly see it. We see it often. One of the big ones is they think they can redraw the debt on a loan that was an investment loan and then use that money to fund a non-deductible purchase or purpose and still claim it as a tax deduction. That's a very common one. It particularly is common when someone has equity or redraw available on an investment loan, and perhaps it was a stepping stone home, and then they redraw that up to use those funds to go towards the future home, the upgraded home, but think they can claim that as a tax deduction. So many people think that is a legitimate deduction.
Mm.
So I'll just touch on a few of the principles before we move into the next stage of what they're targeting, Mike and Kate. So that a few of the principles that we share with our clients and mortgage borrowers. So number one, each time you repay money into a loan, you can never get that debt back to claim the interest as a deduction. So what that means is, like, once you pay down that debt, you can't redraw it back and then claim and go, oops, I would have liked to have preserved that debt. And that's one of the reasons offset accounts are so beneficial. And we actually recommend people not pay down their investment debt ever, unless they've fully paid off all their non-deductible debt and don't expect to borrow for non-deductible purposes anytime in the future. You only get one opportunity to borrow to purchase an asset, and that is when you purchase and pay for it. You can't, again, redraw money later and decide to claim it after the fact. So that is a reason why, if you're borrowing for investment purposes or even a stepping stone home that might become an investment down the track, we recommend you consider borrowing the full purchase price plus costs, or the maximum you're available to do so. So we've sort of touched on it. Redrawing funds from an investment loan to then go towards a new home or a different non-deductible purpose does not allow you to claim a tax deduction, and it's often done when upgrading. A fourth principle is the loan account you use doesn't matter. The ATO doesn't look at the account the money came from, only what you spent the money on. And you need to be able to have a track record to show, okay, this money did go towards this investment. So the day it comes out of your bank account needs to match the day you bought those shares or the day you bought that investment property. If it only matches the day you paid for a holiday or the day you did some renovations on your home, bought some things for it's even if it came out of what was and what you consider an investment loan, that's not dedeductible.
It's a shame, isn't it? ATO, really fun police. When it comes to this sort of
everything.
There's a lot of unhappy property borrowers when we have these conversations with them. I must admit, but it's better to get these things right, because they're all, like, on the flip side of this coin, there's so many things that you can be doing to maximize your tax deductions, which people equally aren't aware of, which we've covered in episodes as well in the past. So quickly, just last couple, the property used to secure the mortgage doesn't determine that it's deductible. So you can have a home loan secured against an investment property. You can have an investment loan secured against a home. People often think, oh, but this is secured against my investment property. Yeah, but the money went towards your renovation or helping fund your new home. That what you paid for with that money is what determines whether it's deductible or not what it's secured against. And the final one is try not to mix your debt. But if you do have a mix of non-deductible and deductible debt, which again people often do inadvertently because they redraw their money for non-deductible purposes, every dollar of interest that you claim will have to be apportioned. You can't claim 100% of that interest. If 20% of that debt relates to non-deductible purposes, then 20%, only 80% of that interest can be claimed. So it's actually, when you break it down into this detailed sort of level, it can be quite complex, and it's understandable that people don't understand all these things and make some mistakes. Is there anything else that either of you two would like to share on that?
I love this. I think to build on that statement, Dave, it can get really complex, but the reason it gets complex is because we stuff it up. When we understand the purpose test and we're very clear about deductible debt and non-deductible debt from the very beginning, our notes to our accountant don't look like a spider web. They only look like a spider web when we've stuffed it up.
Yeah, 100%. And it's the old preparation and planning, isn't it? Like, have these conversations with your strategic mortgage broker and your accountant, but you can do it for free with your strategic mortgage broker. When you're in the planning stage and when you're getting approval and working out the structure, not when you've purchased, and it's too late after you've purchased.
Absolutely. Look, Mike and I were only just talking about you yesterday. We were at in a good way. Well, we said you'd be rocking the corner.
I felt my ears burning yesterday.
Yeah, we presented at a property manager forum, and it was great. Mike talked about plant and equipment and changes to legislation and all of the things that QSs get excited about, and I chatted about investor behaviour and how it's changed. And they also had someone who I hadn't met before chatting about finance, and he was very informative on a lot of things. But one thing he said that just jarred with me was redraw and offset are essentially the same thing. And I just kept thinking, no, they're opposite. No. Because one's deductible and one's not. You're losing something when you use redraw. The only advantage to redraw is it's free, and offset costs you a peppercorn amount in the scheme of things. So when people go for the free product thinking that it works the same, it absolutely doesn't as soon as you're doing anything investment related.
I think you even whispered to me that Dave would be fuming if he heard this.
Lucky I wasn't in the crowd. I would have stormed up the front of the stage and grabbed the microphone.
Absolutely. So the only time that redraw is okay, and I'm all right to say this to our listeners, the only time it's okay is when you are never doing anything investment related.
Yeah. It's got to be for the same purpose as what the purpose of the debt is ultimately. But that it's a great example because many mortgage providers don't understand this stuff. So how can your average consumer or property buyer get it? And obviously this guy is pretty good at what he does. He's been asked to speak for a reason, but some of these nuances he doesn't understand. And I think that's important for our listeners to understand, is that is actually quite common, and it's why you have to be so careful. Anyway, we'll move on because it's probably commandeered enough of this episode.
No, I think it's important because this step, you only get one chance. That's the other point.
Yeah, 100%.
You can't unravel it. Once the ATO has said that's not deductible debt anymore, there's nothing you can do to reverse that.
No, you can't. That's done and dusted. You can only get it right from the moment you realise it was wrong, basically.
There's kind of like, this is a bit of a different topic, and I'll hijack the steering wheel for a second, Dave, because it's a bit of a parallel. Probably the third thing that the ATO often talk about with investors is making sure that the property is genuinely available for rent. So when it comes to being able to claim deductions, whether it's depreciation, interest, property management fees, that sort of stuff, repairs and maintenance, the property doesn't literally have to be tenanted, but it has to be made available for rent. What's the best way to prove that? It was to have a signed agency agreement and a live ad saying, like, this property for X amount a week. So it doesn't actually have to have a tenant in, but it has to be genuinely available. And people get into awkward situations when they say occupy the property to do a little bit of a rental for a couple of weeks, or they might decide they're going to stay in it for a little while, or it's a holiday home, so it's kind of deductible in some times, and then it's kind of like, all right, well, mum's staying there this week, and it's like, well, is mum paying your rent? Oh, that seems a bit mean. Well, ideally, get her to pay you rent and give her the money back in chocolates or flowers or that sort of stuff. Like, that's something that a lot of people
Is that legal, Mark?
It's not financial or tax advice, but that
chocolates. That's the question.
That came from an accountant, actually, because what happened with the Income Tax Integrity Bill in 2017 is that they talked about it being grandfathered, right? So, for example, if you if you bought a property pre 2017, say, and you occupied the property and then you moved out, if you had plant and equipment deductions, you would just start reclaiming them when you moved out. But what a lot of people didn't realise is that when that legislation came in, that was the one that was announced on the 9th of May 2017 that changed the plant and equipment items, is that if you buy a brand new property and then you go and live in the property, let's say 6 months later, from that point on, you actually kill the future plant and equipment depreciation deductions forever. And a lot of people didn't realise that. And the ATO haven't really been exactly clear as to how long occupying the property is long enough for that to be a problem. They have anecdotally sort of said 1 or 2 nights is okay, but 3 or 4 weeks is not okay. So somewhere in that middle ground is where I guess tax lawyers make a lot of money, and that's where the answer is. And
well, I was going to say they're two great examples of the murkiness of owning an investment property. And you could throw in that sort of capital gains tax calculation when it's been investment property and you've lived in it. And the apportionment there is a complex one as well. And I think I think we could actually do another episode on those topics, because they sort of warrant it. So many people do nowadays have that, call it the second home, but because of the advent of Airbnb, they are renting it out for part of the year and living in it, and grandmother's going down to stay in it at times, and other family members, and it can be tricky. It doesn't surprise me. That's an area where there's lots of miscalculations.
Well, even from the outset, our data always hovers in the early 20% of investors actually occupying their property before it becomes a rental property. So
right, that high.
We first crunched that data maybe 5 or 6 years ago, and it had never been seen before. And if I had to guess, I would say, I don't know, maybe 5-10% at most. But essentially, it's nudging up to a quarter of people will actually turn their property that they live into an investment. So that's where, the CGT thing is quite interesting, because, you don't want to pay tax on the whole amount if that was your allocated principal place of residence. So that's where it's kind of like, if it grew by 10%, I'm sure 9% of it was when I was living in it, and it grew nothing when it was an investment property, because that's where you need to get that valuation at that point in time where it becomes a rental, and you'll kind of want to minimize that as much as you can.
Yeah, and it'll be interesting to know the breakdown of people who it's their only property, and so they're thinking we'll live in it initially, principal place of residence, maybe do it up a little bit, rent it out, and then if they've got up to 6 years that it can still sell it and remain their principal place of residence as well, without having to pay CGT. So people try some weird and wacky strategies at times, but I found most of the time when they do that, they just tie themselves in knots and make things worse, to be honest. But,
when I bought my first property, it was a principal place of residence, and I actually rented out one of the bedrooms. And of course, I did a ripping tax depreciation schedule on it. And it was worked out on an apportionment. So there's normally 2 ways you can do it. You can say, okay, well, if it's a 3-bedroom place and you're renting out one room, then it's kind of 1/3 deductible. Otherwise, accountants will often accept, let's say it's 200 square meters and you're renting out 25 square meters of it, then you work out the apportionment there. But it's interesting because you might kind of think, I'm renting out a room, so I'll just claim the deductions for the room. But you're also using a hot water system, which is common to the property. So it's almost like there's common areas within a house. But in that situation, I occupied it just myself for a while because I got the first home buyer grant, so you can't mess around with that, or the state revenue will get you. And I've heard plenty of stories about them getting people that I know. But I actually had to get a valuation at the point where I was renting out that room, and when I eventually sold the property, there was a CGT debt there as well, which I knew. That's what I was
going to say. Thankfully. You didn't know about that? Yeah. Yes. Okay. Yeah. Did that make you second guess though doing it? Did the actual deductions offset the loss of the capital gains exemption? Did you
Yeah,
do
well,
the maths on that?
it was, yeah. So I actually did the numbers with an accountant before we made this decision, and that's like, I mean, that I'm not going to claim credit as being a genius for doing that. I think I probably just had a proactive accountant. Not everybody does, but
No,
like
you would have.
I hear so often that. Sorry.
You would have been the reason that
Thanks,
happened,
Dave.
Mike.
Thanks, Dave.
let's
Just make sure you
let's be honest.
put it in the reviews. Look, I think I hear so often from accountants that people come to them and they go do their tax return and they say, "Oh yeah, anything I should know?" And they're like, "Oh, I bought a property," and the accountant's like, "Oh my gosh." Of all the people to talk to before you buy an investment property, I've like, if I'm not on the podium, like I'm galloping ahead and winning this race. So like, it's so important that a mortgage broker and an accountant communicating strategically to say, what is the outcome of this from a tax situation or from a deductibility situation?
Yeah, 100%. If you've got a good strategic mortgage broker and a good accountant, it's not that complex, but you don't know what you don't know if you're the property buyer investor. And if you're not getting that sort of advice in advance, well, that's where all the mistakes happen that you can't unravel. Yeah, but you can change down the track, but you can't go backwards in time, however much deductions you've missed out on. And, the amount of debt you've paid down that you otherwise wouldn't have, or you've, set it down for redraw rather than have an offset, or whatever the mistakes are made, they last forever. And that they can run into tens of thousands of dollars or longer over a lifetime if you're owning the property till 65 or beyond. Very good, very good. Well, that's good. We've gone off on some very useful tangents there, I think, for our listeners, Mike, and probably just opened up a bit of a can of worms that we could probably cover, spend a whole episode on. Kate, what's the ATO's stance here?
Yeah, the ATO are quite strict on distinguishing between repairs and capital improvements. So repairs and maintenance, like fixing a broken window or replacing part of a damaged fence, can be claimed as immediate deductions. However, capital improvements, such as installing a new kitchen or adding a new room, are considered capital works and they must be depreciated over time.
Awesome. That sounds pretty straightforward, sort of, but I bet it's easy to get wrong.
And it is.
Any tips, Mike or Kate?
Yeah, it's something that, as I said, the ATO talk about it every single year, and people get it wrong. And I think sometimes it's kind of strategic because, well, what's the difference? What's better, repairs and maintenance claim or a depreciation claim? There's a big gap between a repairs and maintenance claim and a depreciation claim. Repairs and maintenance.
When you say there's a big gap, what do you mean? Like a big gap in how much you can claim and the benefit of repairs and maintenance versus depreciation?
Yeah. It's a timing thing. So a repairs and maintenance expense is an immediately deductible expense.
You're talking about the timing.
In the year that it's incurred. So if you have, say, $10,000 worth of genuine repairs and maintenance expenses, then that's a $10,000 deduction in that financial year, which, depending on your marginal rate, could be, $3,500 back in your pocket, right? Whereas if that is, let's say it's all capital work, it's all Division 43, it's all structural improvements rather than repairs, that's a 2.5% claim each year over 40 years. So $10,000, you're getting $250 a year for 40 years instead of $3,500 back in your pocket in 1 year. So of course, repairs and maintenance are gold for investors where it's genuine. And when we do tax depreciation schedules, we used to sometimes get a shoebox full of receipts. We had to update our terms and conditions because we were losing a lot of money, punching that in. But we often get these Excel spreadsheets that just has a sea of improvements, like a sea of line items of we did this, we did that. And often we have to go back and say, like, when you say, like, on the 1st of January, you spent $30,000 on things, what did that mean? And what we actually do as part of that process is that we'll capture anything that we think is justified as repairs and maintenance, because to put that in the depreciation schedule is doing a disservice to the investor, because if they can claim it as an immediate deduction and that's available to them and it's genuine, then that's a superpower. That's a great deduction. But you have to kind of think, and the easiest way to think about it is, are you restoring the function of something that stays in place, or are you putting a brand new asset in? So if you're replacing a couple of roof sheets, then you are kind of repairing the roof. If you're putting a brand new roof on, that's a new asset. Let's say, for example, if you have a hot water system that has a broken pump and you replace the pump, then that is really a repair to the hot water system at large. But if you have to throw that hot water system away and get a brand new one, then that's a depreciable item, and it could have a 12 or a 15-year effective life, depending on whether it's gas or electrical or solar and that sort of thing. And yeah, the difference is in timing. And why does timing matter? Well, I think there's two reasons why timing matters. One is that $1 today is always worth more than $1 tomorrow. It doesn't even matter if inflation is as high as it is. It's not just it all. I mean, I'm old enough to know that back in the day I could get sent to the shops with 20 cents and come home with a bag full of lollies. Like, that doesn't happen anymore. The other one is, like, if you're a property investor, I always kind of think the hardest time to hold on to a property is day one, because over time, hopefully, you may pay down some debt. The rent presumably will go up in time, and then later on, inflation kind of decreases the value of that debt. Your salary might go up, so it's so much better to get the deductions straight away if you can.
Yeah, that's really well explained. Again, these areas that I think a lot of property investors understand on the high level, but the depth underneath it is not really properly understood. So it's really helpful. That's great, Mike. Thank you. Now, I know Mike's going to want to talk about tax. No, we just did talk about tax depreciation. But Kate, can you explain what is tax depreciation, how easy it is to overlook getting it done?
For the uninitiated, there are opportunities out there for you to recoup essentially your losses, and your losses are, as these things age, they're losing value. And so the ATO is sharing that burden with us. We're paying tax, and we can recoup some of that back that represents the losses that we've incurred while effectively running a business. The reason why Mike's asked you to ask me if it's easy to overlook it is because I overlooked it. And not all of it. Oh, you know what?
This is a stitch-up job.
Yeah, thanks a lot. And he's also dropped an Easter egg in there, and I'm not swearing on the show. But we've been pretty good with organising all of our depreciation reports. And the one property that we really should have focused on was the one that we completely renovated. It was a very significant, town planning, heritage involvement. We did a significant renovation on a little single front Victorian property in Spotswood that we have. And it took us the better part of a year to do this renovation. So it was significant. And we kept all of our receipts and details. It was an owner-builder effort. So, I should have been all across this. And it was just a classic case of, you've done it, haven't you? Yeah, no, I thought you did it. Oh, no, crap, we haven't done it. And then I called Mike and said, this is more than 2 years ago that we should have got this sorted. So I've lost some valuable deductions on a property that should have had a quantity surveyor through to do a depreciation report back in 2019. So I'm feeling like an absolute goose. And it can happen. You can overlook these things. Sometimes it's because you don't understand that you should have got an inspection coordinated and had a schedule done. Some people assume that they don't need one. Yesterday, for example, in that session that we had, someone's accountant said to them, no, don't worry about it. It's not worth claiming. And Mike actually ran the ruler over it and got them an immediate $4,000 back in the first year. Now, that's definitely worth claiming.
Really?
Because, yeah, if a depreciation schedule costs you, I don't know, $700-ish, and you're getting $4,000 back in the first year, and then obviously it's a sliding scale after that, it diminishes, but you still, there might be like
Still ahead of the game.
$7,000, $8,000, $9,000 in total worth of deductions that one report delivers you over the course of a few years. So you shouldn't rely on anyone other than a qualified person to tell you whether the property actually qualifies or not. And that's as simple as reaching out to Mike's team and sending them a link of the property and saying, check this out, do you reckon it's worth getting you fellas over here? Because they'll be very quick to say no if it's not worth it. So it can be easy to overlook it, A, when you don't realise that you've got deductions, and B, when you're a goose like me and you assume that your partner's already done it.
Yeah, but I think it's actually quite common when you're doing the doing. And let's say the doing is buying the property. The doing is doing the owner-builder renos. Often we just go, we're so busy, we're doing so much stuff, and we don't seek the advice to make sure we're getting the structuring right, whether that's mortgage strategy, whether it's claiming a full depreciation, whatever it is. And so that, like if there's one message or of the many messages going out from this episode, it's make sure you get that advice and take the time to get your advice at the same time as you're doing the doing, and not just do the doing, because that is the big part. That's the major component. But if you miss out on this 1 or 2 or 3% of getting the advice, you're still going to cost yourself a fair bit of money come tax time, as we've outlined in the episode. Mike,
that was a real stitch-up job. And the only reason I brought it up is because when Kate was in Newcastle, she was sort of saying, we should do like a Monday minute reel about the fact that I forgot to do it. So I thought, she's happy to talk about it. But now I feel like I've just gone out like baby seal clubbing and rubbed my nose in it.
Do you know what? I think it's a great story. And it's really good for our listeners to listen to a real life story, case study example. So I think you've done well, Mike, and I think Kate's
yeah. Well,
big
Mike,
enough
let's
to
just talk about the
comfortable to share
magnitude
that.
of the losses. Let's assume we spent, I don't know I do know the exact figure, but to keep it round, my husband did a lot of the work as well. So let's talk about the renovation. If we'd had a project manager and full-scale building team there, let's say $250,000, $300,000 renovation. Let's say 300 to keep it round. And I finished that in 2019 and didn't tell you about needing a tax depreciation report until 2024. Just give us a ballpark what losses we've left on the table.
Oh, do you really like you've got this gaping wound open on the surgery table, and I'm just here with the salt going, all right, are you ready, baby?
Yes.
Yeah, well, I think
Kate said she's going to replay this part of the episode to Ian. So.
I'm going to say at least $7,000 in 1 year.
At least that'd be more.
In 1 year, so
I kind of thought, do I sprinkle the salt or do I back up, like a trailer and tip it in? So, but yes, at least 7.
And the good news is I can go back 2 years. So it's all is not lost, but a lot is lost, and it's the juicy part at the start that's the most significant.
Yeah,
having the humility to share, that's awesome. And one of the top property investors and advisors in the country, and it just goes to show and why these things are so important.
Yeah,
but I mean, that's not Kate's area of expertise. And, it's one of those weird kind of side nuances to the whole investing game that it's not in, the top percentage of things that are important to get right as an investor. Like certainly you can kind of use money. So like I do actually find that doing podcasts, people really resonate with experts showing humility and saying, look, I didn't get this right. And
we should have great ratings then.
Yeah, I hope so.
We've had an episode on our biggest mistakes, haven't we? Among other things. Yeah, look, but I think, again, it reinforces why we're doing this episode, and so much about of what's important with property investing is people aren't experts in all these areas. Even if you are an expert in this industry, you can't be an expert in all these areas. So we all learn from each other doing the podcast, as well as when we're making our own investment decisions. So, Mike, what are the basics an investor needs to know about tax depreciation, specifically at tax time?
Yeah, well, as at the time of recording, we've still got a couple of days to play for the end of financial year. But when it comes out, we might be in July. And a lot of people panic around this time of year. They say like, oh, I've got to get the depreciation schedule done by June 30. That's nonsense. The only reason that's important from a timing point of view is if you want to claim the fee for the report. So when you go and see your accountant and you pay to have your tax return done, that's actually a tax deductible expense as associated with managing your tax affairs. A tax depreciation schedule is the same. So if you want to claim the deductions in this financial year, you just have to pay for it this financial year. So we don't do upfront payment, but this time of year, we just let people know, if you want us to raise an invoice, we will. Here's the reason why. But a lot of people are panicking. I have to get it done by June 30. The report actually starts from your settlement date. So if you bought the property in February the 27th, it'll start on February the 27th. So it'll show everything you're entitled to claim. The only time you really need to have it done is ideally by the time you have an appointment with your accountant. Now, it takes a little bit of time to get your group certificates and your bank statements and your health insurance figures and all that sort of rot that you've got to collect to give to your accountant. But even if you don't have it done by the time you go to an accountant, and of course we get a lot of referrals from accountants that sit down with their client and say, have you had a depreciation schedule? And they say, no, what's that? So they can basically do everything on the tax return, and they just wait for our report, and essentially they can just plug in the number and hit send, or however it works. I'm not an accountant. And ping it off. So timing is one thing I wanted to talk about. I wanted to sort of share as well, like how to tell whether you have a property that's worthwhile for deductions. And I came up with kind of 3 triggers to sort of communicate to people. If it matches any of these triggers, then there's worthwhile deductions very likely in the property. I'll go through them quickly. One is you buy a brand new property, and we all kind of know why brand new is better for deductions. The second one is if it's built after 1987. Now, there's a specific date, but I've sort of stopped mentioning it because I don't want people to get hung up on trying to remember the 16th of September. There I go again. I've said it.
It's
but
7
if it's
p.m.
7:30, I think, because that's when the budget speech normally starts. So if the property's built after 1987, it means the original structure will qualify, like the bones of the building. So that's the timber, the gyprock, the concrete, all of those kind of fixed assets, including cabinetry and tiles. So if it's built after 87, it's worthwhile as well. The third one is it doesn't match trigger 1 or 2. It's not brand new. It's not built after 87. And this is where a lot of people get stuck. They assume that there's not going to be any deductions available. But if it's built in the 20s or the 50s or the 60s or whatever, we need to look at the history of the building. So if it's had some substantial improvements, it's had a kitchen or a bathroom renovation, then quantity surveyors are actually qualified and recognised by the tax office as able to estimate the value of those works. So that could be done by the blood, sweat and tears of the previous owner, but that's kind of baked into your purchase price. You inherit those improvements and those deductions. And we like to see about 40 or 50 grand as a minimum, because $40,000 at 2.5% is $1,000 a year. 2.5% is really the lowest rate of depreciation that you can claim. So what's $40,000 or $50,000? Well, you used to be able to get a kitchen and a bathroom for that. Those days are maybe gone now. But if you're looking at the property and you can see that it's clearly been updated, or it's extended, or it's had a new roof or new driveways, all those sorts of things were they count towards it. But you can jump on our live chat. You can go and see your favorite neighborhood quantity surveyor, and they will most likely give you free advice. If you just give them the address, there's online photos of pretty much every property in Australia. They can go and say, yes, I think we would get between X and Y deductions. So those are key things there. I wanted to also talk about how the deductions go into your pocket, because I think people get a depreciation schedule and they go, oh yeah, I got $10,000 worth of deductions, so I get $10,000 cash in my bank account. Well, no. What it does is it just really reduces your income for tax purposes. So if you own a property in a personal name, and you're on $100,000 a year, and let's say you have $10,000 worth of deductions, you're going to pay around about $23,000, $24,000 in tax. Now, if you have $10,000 worth of deductions, and that will actually reduce your taxable income from 100 down to 90. So that's really the point of it. It's a deduction, just like a tradie might claim boots and sun cream, or an office worker might claim textbooks and dry cleaning if their shirt's got a logo on it. It's really no different. So it just minimizes your taxable income. And in that example, it's going to be roughly on the tax rates for 23, 24, around about $3,200 back in your pocket. So still very significant, but the deductions don't actually equal cash. It just depends on your marginal rate. I think I had a little point about how to select a tax depreciation firm. I'll sort of glaze over that only to say that there are a certain number of firms that are talking about getting a depreciation schedule report a little bit cheaper because they don't inspect the property. The only time you really kind of want to do that is if you know that they've already been to the exact property or all the costs are known. Let's say you build an investment property, you know the exact costs, so you don't need someone to estimate it. You'll have the plans and the schedule of finishes, so we don't physically need to inspect it. But if you buy something that's established, we need to go and look at the history of the property. I've stood in properties with owners where I've said, like, this property's been renovated and extended, and they look at me puzzled and like, yeah, this is where the rear wall would be. And you can have a look underneath and see the steps going up to the middle of the building where the back door used to be, right? So that's part of our skill set, is being able to forensically understand what's happened to the property over time.
That's an important tip, I think, for our listeners. It's obviously it's slightly self-serving, but at the end of the day, I think, you've made the point really clear that people are going to miss out on deductions, basically, if someone isn't getting through the property.
We don't make money on going to do the inspections. In fact, I'd love to run a business where we didn't have to have a billion Toyota Corollas and a bunch of staff all around the country. Like, it's hard to manage a national inspection force. It's one of the reasons why our business is, reasonably large from a small business point of view with headcount, because we actually have to cover all these areas. But it's the right thing to do. Like, I don't want to run a business that isn't doing the absolute best for the clients. So we're always going to do that. The last point I wanted to talk about was ongoing maintenance of a depreciation schedule. So people will ring up every year and say, like, oh, I got a depreciation last year. Can you do another one for this year? I wish that was the model we worked on, because I would have been retired 20 years ago. But our report lasts for 40 years. So what happens is that perhaps in the last financial year, let's say you add a brand new split system to the property. Well, there's no estimating required. So your accountant could actually go and look up the effective life of a split system and work out the depreciation rate and plug it straight in. But for our clients, and I know for a number of quantity surveyors, if it's one or two improvements, they will actually just update your depreciation schedule free of charge. And I hate the idea of having a schedule and then it not being connected to the reality of what's happening year to year. I think it's a good idea to keep it updated. And unless it's a myriad of things or a big renovation, we're not likely to charge for that sort of stuff.
Really? That's a great tip as well. And a lot of people wouldn't even think to do that, I reckon. Yeah, that's great. Kate, we've talked many times about your portfolio. Any tips you have for making tax time easy when you have such a large number of holdings?
No, if we back out the Spotswood blunder, yes, I do. And it's all about record keeping and understanding who's on the task. That's not just about Ian and I. That's also about the property managers, because when you've got a property being managed by a property manager, they'll send you a financial report at the end of the year. That's part of their service. Most won't charge a fee for it. And that will show all of the items that you've had to attend to throughout the year, whether it's been services or materials or a combination of the two, or replacing things. And they segment everything for you. And that can be simply handed to your accountant. If you love your spreadsheets and you like to be hands-on yourself, it is about record keeping. And it's also about invoices. That's really important for anyone that's ever chatted to someone who's been audited, or if they've been audited themselves. It is all about your invoices. And so if you can get yourself into a very good habit with invoice saving, that can really help you. And I'm not talking about a shoebox of invoices. I'm talking about scanning a clear invoice and apportioning it to the right folder. And I personally find that if I do that as soon as the invoice lands in my hands, it doesn't get lost into the ether. And putting it in the clear file and numbering all of your files in financial years is really important. So it does sound a bit onerous, but when you're in a habit and it's a clean habit and you've got yourself used to it, then you can do it. You can also get apps on your phone to save an invoice as well. So you can scan it pretty simply, make sure your resolution's okay, and it goes into the file. So there's some of the things that I'd recommend you do, and be very clear about who's responsible, because it's when you're assuming that someone else is doing something that things can fall apart a little bit.
Love that.
Yeah, that's awesome. Very similar to running a business, really.
Yeah.
I'm not always the best on receipts, I must admit, but I'm getting better.
You are running a business. I think that's the important thing for investors to know. Whether you've got one property or 20 properties, you're running a business, and you've got to make sure that all of your business activity is traceable and clean and clear, so that it's easy for your accountant. But always imagine worst case scenario is that the ATO says we're doing an audit on you. And it's not a very pleasant experience for a lot of reasons. I've been through it. Not because I had any issues with the ATO. In fact, we got a pat on the back. But the time that it takes you to pull things together and to go down to the post office and send files and files and files to Albury, not much fun. And the ATO, they don't turn around stuff and have an SLA like you think they might. It took us over a year for them to go through everything and then say, yeah, you guys are all right. And then we got our deduction. And you know what? The ATO, they don't pay interest on what they owe you.
Yeah, yeah. And do you know what? that interconnects neatly with if you're going to the problems that come up with your mortgage structure. If you're going to redraw, for example, what is it you're paying for? Have you got a copy of that receipt or invoice? If that receipt or invoice or whatever you've paid for when you've done the redraw isn't a tax deductible item, well, then that portion of the debt is no longer tax deductible. It completely intersects, but people won't think of it like that. You know, the date that money left that loan account, you need to have an invoice or receipt that matches up to the deduction if you want to claim that amount, because that's all the ATO will do. They'll go through and look at, okay, the loan was drawn down here, there was a redraw here, you've been claiming all this, show me the invoice or receipt that matches up to that drawdown, that redraw. And if there's not something that matches up to it, well, it's not deductible. So look, that's been a really great episode, guys. Before we wrap up, is there any final thoughts?
Yeah, just a little reminder to all the investors out there to take their time with their tax returns. Rushing it can lead to mistakes, and it might attract the ATO's attention. And make sure all income and deductions are accurately reported. You can go onto the ATO website if you need some support there. There's a lot of good quality information that they provide you when you're preparing your own tax return.
Mike, any last thoughts?
Yeah, look, I just think, and this won't make me popular, but I think we need to reframe tax time as fun. Like it should be fun. It's the moment popular. Where you get your sort of end of financial year reports, and it's like, well, this is the position, this is what we did, this is the refund, and you can go and blow it on a jet ski or whatever people do that wouldn't be financial advice. Look, I just think it's something that's a necessary evil, but I think if we can kind of reframe it and we can prepare for it throughout the year rather than just going, oh my gosh, I've got to get all this stuff together. We set a system in place that is like running a business, then it should be easy.
I've got this thought bubble in my head of like one of those 1980s style ads run by the ATO. It's tax time, fun time. Go and get your tax done.
Yeah, give us a call, ATO. I'm your man.
Yeah. Look, that's been a really good episode. Some great stuff in there, particularly from you, Mike. I think that's been really useful for our listeners to share some of that, more of that knowledge that you have. So without further ado, let's go into our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
We've talked a little bit about the ATO portal and things that people need to keep in mind when they're organising their own tax return. I think for a lot of our listeners, if you're already active in property, if you're a property investor, and particularly if you have other investments or if you've got different entities, your tax affairs are probably starting to get a little bit detailed. They're not simple at all. And you might find that it pays to go and see an accountant to prepare your return for you. And I don't want to suggest that everyone needs to spend money on an accountant doing something that they can do themselves, but once it gets tricky and detailed, you'll find that accountant will have some really good ideas to help you save your tax and might bring up things that you hadn't thought about.
We talked a little bit here and there about treating it like a business, and it is a business, and it should be treated as such. I think that we shouldn't be kind of thinking, oh, tax time's coming, we've got to do all of this work. We should put some systems in place that kind of work throughout the year. Kate made a good example, and I don't have the portfolio of Kate that's as arduous to kind of manage, but little things like getting your property managers to pay expenses from the rent, that means that they're capturing invoices and they're kind of required to present that financial statement at the end of the year to say, this is the rent coming in, these are the management fees, this is what we spent money on, here's some lawn maintenance, here's a new asset, and then you can give that to your accountant fairly easily. I think every property investor should have an accountant, and many accountants also do offer an audit insurance package as well. So as Kate mentioned, an audit can just be a random thing. Sometimes people are targeted for different reasons, but it's an arduous thing that would incur some expenses. And if you're wanting your accountant to run that, they're not going to do that for free. So that's something to consider as well.
My gold nugget will be a little bit self-serving, but if you feel like if you've got a property portfolio and you feel like you haven't been getting strategic mortgage advice, then try and find a strategic mortgage broker who can then look over your structures, because we find nearly all the time that there are more deductions that someone could be claiming if they had their structure the right way, and there's often some mistakes that have been made. So that'll be my gold nugget for today. Thanks for that episode, guys, particularly Mike. Some real gold in there. And I think our listeners will be better for it.
Agreed. Awesome job,
Tax
Mike.
time's fun time.